This podcast is for information purposes only and is not and should not be construed as professional advice or an offer or commitment by any Rabobank group member to enter into a transaction. The views expressed by the presenter and or guests are their own and do not necessarily represent the views of Rabobank. Please see the podcast description for our full disclaimer.
Most farmers and growers will have some form of relationship with a bank. However, the nature of that relationship can vary greatly, from a very transactional relationship right through to something that's much more akin to a partnership. This raises the question, how can you go about maximising the value of the relationship you have with your bank? I'm your host, Blake Holgate, and to explore this question a little further, I'm joined today by Rabobank's General Manager for Country Banking, Bruce Weir. Bruce, welcome to Growing Our Future podcast.
Yeah, thanks, Blake. Really appreciate you having me.
No, looking forward to this one, Bruce. Look, I know your background pretty well, but our listeners may not. Do you want to give us a little bit of detail about yourself, your career to date, and your current role at Rabobank?
Yeah, so I grew up immersed in a sheep and beef farming background in the rural community of Newhaka, which is part of the Wairau County, about 2 hours north of Hawke's Bay. From there, I attended Newhaka Primary School, went on to Wairoa College. Now, although I don't spend too much time back there these days, I still call it home. A real privileged upbringing and background. From a young age, probably like many rural bankers, Blake, I was always destined to be a farmer. But my mother encouraged me to go to Massey University for a year, where I did a diploma in agriculture. From here, the theory, the practicality of farming all came together. The university lifestyle I really enjoyed. So I actually stayed on to complete a Bachelor of Applied Science, majoring in rural valuation and management. From there, after university, went back farming for a bit until a mentor suggested I should just round out my skills, try rural banking for a year or two before I come back to the farm. Now, that was 25 years ago. I've been real fortunate over those 25 years where I've held various roles, worked in a number of different areas. I've considered, again, probably like all rural bankers, Blake, I've considered transitioning back to farming a few times. But each time I was about to transition, even though the time was right, the opportunities were there, a downturn like the global financial crisis or a dairy crisis hit. And I just couldn't actually leave my clients during those tough times. My clients actually have been really loyal to me. So I thought it was my time in turn to support them through those tough periods. Now, as General Manager of Country Banking at Rabobank, a role I've held for the past 6 years, I lead and am part of a team of about 280 agri-bankers. And it's a really privileged role, a role where the whole team is extremely committed to adding value and making a difference to all our farming families, agribusinesses and rural communities.
Excellent. And we're going to dig into, what that looks like a bit more through the podcast. But let's start by just, at a high level, are you able to describe, in your view, Bruce, what a good, healthy bank-client relationship should look like?
I think that, first of all, Blake, you actually need really good trust and transparency. A relationship of mutual trust and open communication is essential. And both parties should be honest and transparent and really just ensure that the expectations and realities are clearly understood. Another area is understanding needs. A bank must take the time to understand the client's business, financial and personal goals. Now, this deep understanding allows the banker just to provide real tailored solutions to truly meet, like I say, clients' needs and aspirations, but also challenges them and challenges each other to think different when needed. And I think the other thing, Blake, is proactive support. As a banker, we should be providing proactive support, and we should do our best to anticipate challenges and opportunities, offering guidance and help for our clients to succeed and grow. And every interaction should be one of value. And overall, I talk about this a lot, accountability and flexibility. I think both parties should do what they say they're going to do and own it when they don't. As we all know, Blake, is at times we understand and recognise that sometimes things just happen outside of our control. But when this happens, we need to be comfortable to own this and also be comfortable to constructively challenge each other to achieve those best outcomes.
So from what you've told me, Bruce, it's a proactive relationship rather than reactive. It's not simply sitting back and either waiting for the client to necessarily come to us with a proposal or waiting for your bank manager for the next annual catch-up. It's being fully engaged, and you use the word challenge a couple of times, and that's potentially where some of the healthiest relationships actually operate, where there is a good, healthy tension or challenge between the banker and the client.
Absolutely. I think where there's real healthy respect and challenge, it brings the best out of everybody and makes sure that either party are not complacent.
And it probably links to your first point around, trust, right? Because to be able to have that challenging relationship, you've got to trust the other party as well.
Absolutely.
What are some of the key factors or considerations that banks take into consideration when assessing clients or maybe potential clients, whether they want to enter into that relationship at all?
Yeah, you've heard of the 5 C's. I'll refer to the 5 C's. There seems to be a real common theme to describe. First of all, we've got the customer. We've got to understand who we're lending to. Is it an individual? Is it a partnership, company, trust, etc.? And once they're ascertained, character, who are we dealing with? What is the client's history, experience, reputation, community involvement? Can we work with each other? Can we trust them as business people? Can we meet their needs? Capacity, Blake, you would have heard of. How would the loan be repaid? How operationally resilient is the business? How sustainable is it? Are we certain of the cash flows? Is there key person risk? What are the mitigations? And then we move into collateral. How can we secure ourselves against the risk? What are the assets being offered? How sustainable, how viable, how valuable? And finally, conditions. What are the terms being sought? How will we structure the loan to meet the client's needs? What external factors and specific risks that we need to be considered? And how do we actually balance the whole environmental and financial sustainability?
And those 5 C's, Bruce, have they changed over your time in banking, or have perhaps the emphasis or focus around aspects of part of them changed over time?
Yeah, it'd be safe to say they have, Blake. As you well know, we've seen this massive shift from one of being a production increases, land use change and capital gains to create wealth, to cover cash losses in the past, to one now that's actually more wealth creation via cash. So we do look at, let's use the 5 C's again. If we look at the customer, initially the focus was on basic demographic and financial information. Now there's a deeper dive into the customer's business resilience, including the ability to adapt to changing conditions and maintaining, like I say, that balance between environmental and financial sustainability. That character, while trust and reputation have always been important, now there's a greater emphasis on the client's history of managing through downturns, the ability to plan, ability to strategize, and particularly important when the leverage is elevated. Now, if you look at capacity, previously, as I mentioned, the ability to repay loans was often based on, should we say, production increases, capital gains, and today the focus has shifted to operational efficiency, return on investment, the sustainability of cash flows. We now look at how resilient the business is and how well can it sustain itself through economic fluctuations as well as adverse weather events. And if you look at collateral, collateral has always remained important, now become a wee bit more nuanced. We elevate the security, viability and overall value of the business offered as collateral rather than just their probably immediate market value. And finally, conditions. Again, as I talked about, the term of the loan, the external factors have always been considered, but now there's a greater risk on structuring loans to meet specific needs. And again, greater emphasis on understanding sector-specific risks and ensuring that loan supports that long-term viability rather than that just short-term security. The difference is when I talk about risk, horticulture versus dairy, for instance. Horticulture, one harvest a year, dairy, multiple harvests.
And presumably those changes and maybe looking a bit deeper than did historically isn't just for the bank's benefit, right? These are looking at the client's business and helping work with them to get a deeper understanding around ultimately, what will that investment mean for the long-term success of their business. So it's a two-way street there, really.
Absolutely. Like we as a bank take a long-term view. We want to set up clients' businesses for the long term. So we can really work through those plans, those strategies at onboarding. It's going to make sure that those clients evolve and we evolve, and they're going to continue for generations.
So what could farmers do to put themselves in the strongest position to attract capital from banks, Bruce?
I think, first of all, a farmer like us all, Blake, we actually really need to be very clear on our purpose. Do we really understand why we do what we do? Where do we want to go? What does success look like, and what are the milestones along the way? I think once you're really clear on your purpose, this will then help us to know, understand, and own our numbers, both from a financial point of view, from an environmental point of view, and we talk about a lot. We just need to really maintain those accurate and up-to-date financial records, understand those key financial metrics such as profitability, debt to asset ratios, how P&L, cash flow, and balance sheet all speak to each other. Where's your cash going? And just really be prepared to discuss how your business can sustain itself through economic fluctuations, downturns, adverse weather events, etc. And we're quite lucky in today's world. There's a number of tools to help us with that, Blake, like Farm Focus and Figured are really good tools to help support that. Like I mentioned, try and balance that environmental and financial sustainability. Show how your farming practices balance that, and just continue to build that trust and transparency. Foster that relationship based on trust and open communication with your bank. Just be honest about your businesses, be honest about your strengths and weaknesses.
That's what you should do. What should you avoid doing if you want to be getting money out of a bank, Bruce?
There's probably a number of things, but I think, Blake, just avoid short-term focus. Avoid focusing solely on short-term gains. Like I said, farming's a long-term game. We're a generational business, so just prioritise that long-term sustainability and viability over immediate profits. And I think if I look at the immediate, or I guess more recent times, high cost structures. I think if we can really avoid locking ourselves into high cost structures that push the break-even point to unsustainable levels. And it's very easy to do when commodity prices are strong, interest rates and input costs are low. And we're seeing that through the period of those low interest rates, around 2.5%. The payout was good, input costs were low. And I guess we just, in some cases, some of us just took the eye off the ball and really pushed some cost structures to that unsustainable level. Like I usually say, it usually takes 1 year to get over a tough year, but can take several years to get over a good year. And we certainly, as I said, saw that during the period of very low interest rates, which caused many to relax.
Yeah, so it's avoiding those sort of structural, embedded, high-cost structures. I mean, obviously you'll have fluctuations in a season, but once it becomes sort of embedded, it creates a longer-term challenge for the business.
Yeah, that's right.
That's sort of, what we've talked about a lot to date has been around the relationship between the client and the bank. But what about that more personal relationship between the client and the bank manager or relationship manager? What is the role of the relationship manager within that broader relationship between the bank and the client?
I like to call our bankers trusted business partners. We're a team, provide tailored guidance to help our clients make informed decisions. And by being a trusted business partner, they take the time to really truly understand our clients' needs, goals, aspirations, understand the business model, understand the challenges, and understand why they do what they want to do. Where do they want to go to? And we touched on it, that proactive support. Offer proactive support, anticipate challenges, and just provide that long-term support for that long-term sustainability. It's all focused for me on those long-term partnerships. Focus on building those lasting relationships with regular communication and trust, and just leverage those expertise. I think for us as a banker, it's not our job to know everything. It's our job to know a wee bit about something, be that conductor. So it's about us identifying when we need to bring in specialists to provide that comprehensive support. But our role as bankers, it should be at every interaction. We should be looking to add value to our clients.
So ultimately, that's what clients should expect from the trusted business partner, Bruce, is adding value around that kitchen table.
Absolutely, Blake. They should expect that transparency and trust, that understanding, support. Talked about that proactive support. Every interaction, every touch point should be one that creates value. And clearly, long-term business, so they should expect long-term commitment and prioritising that long-term success over short-term gains.
What about more generally? How well placed do you think the New Zealand ag sector is to continue to being able to attract capital? As you look kind of 5 years into the future, do you think we're well positioned to attract capital to the sector to continue to fuel the growth that we'd all like to see?
Yeah, I believe so, Blake. I think the sector is well placed to continue to attract capital over the next number of years. And I think that's thanks to our strong foundation and adaptability. But I think there are several factors that will influence those capital flows. First of all, we want clearly economic stability. I mean, our overall economic environment, including interest rates, and inflation, can clearly influence investment decisions. We need a stable economy. We need good market access. Having all those will encourage more capital flows into the sector. We speak a lot, Blake, as you do on this show, regulatory environment, government policies and regulations, particularly those related to environmental sustainability, land use, and ability to consent for longer periods of time will play a significant role. Supportive policies will attract more investment.
And you mentioned a few situations during your banking career where presumably capital did get tighter, and events often outside the control of New Zealand agri-sector or New Zealand farmer. So, there is a real chance that happens again. There's a period of tightening of capital where it is harder to attract capital. What can farmers do again to prepare or be in the best position to ride out those situations, Bruce?
Yeah, those are tough times, Blake, and I've been there before. So we want to really continue to position our businesses well so we can continue to attract capital. Efficiency and return on investment. Continue to prioritise that operational efficiency and return on investment. We talk about a lot, demonstrate that consistent cash flow and sustainable business practices. We haven't talked a lot about risk management, but we need to have risk management at the forefront. Businesses with effective risk management strategies, including diversification and resilience planning, is essential. And farmers and growers who can really demonstrate their ability to manage risks such as climate, market volatility will be always appealing more to investors and banks. And I think a new one, Blake, and I think about this a lot, technology adoption or technological adoption. We've got to continue to embrace those new technologies to continue to evolve, continue to improve productivity, and really just future-proof your operations. Sustainable business practice, again, continue to balance that environmental, sustainable aspect. And I talk around about this a lot too, Blake, understand and own your numbers. Just continue to maintain accurate financial records and understand your key financial metrics, which leads into long-term planning. Continue to focus on that long-term viability rather than short-term gains. Plan for succession and future growth. I think if you adopt those sort of factors, the New Zealand agricultural sector, farmers in general, can continue to attract capital and thrive in the coming years.
Yeah, I think that long-term focus is such a key one, right? Because farming is cyclical by nature. So we know there'll be those challenging times. And often, we find the farmers and the sector as a whole is incredibly focused through those periods. But I wonder if it's also just as important to be focused and during the good periods, because they're ultimately the periods that are going to set you up over that long term and put you in the position to get through those rougher periods. So it's keeping that laser focus when things are going well and the cash flow is there, but not taking the foot off the pedal around what does this mean for the strategic direction of my business.
Yes, 100% correct, Blake. Like, it's really easy just to lose a bit of focus in good times when we say commodity prices are high, weather is playing the game, and we just relax a bit and remove focus. So it's really important in those good times that we use profits wisely. We understanding the link between cash flow, P&L, and balance sheet, just to position our businesses for resilience, but also for future growth. Because largely good opportunities come counter cycle, right?
Yeah, exactly. Yeah. I mean, if you're in a strong position through those tougher times, that may create opportunities for yourself and your business.
Absolutely.
Look, Bruce, that's been a really useful, informative discussion. Any final thoughts or messages around how farmers can get the most out of their relationships with their bank before we sign off?
I think just touch on those relationships, Blake. Continue to build strong relationships. A relationship that's built on transparency and trust. Farmers, again, continue to focus on open communication, clear understanding their financial and operational metrics, collaborate with specialists. Farming's become quite a complex world, so sometimes we really need to lean onto specialists where needed. Just continue to embrace that sustainability and innovation. The future of New Zealand agri, it does hinge on balancing that sustainability and financial viability, which will support us to continue to evolve, leverage technological advancements, and plan for that long term. I can't emphasise enough, continue to plan for that long-term viability over those short-term gains, and have those effective risk management strategies alongside your strategic plans in place. It'll set us up well, Blake, as you and I talk a lot about. It's really exciting times ahead of us. There's plenty of opportunity in front of us.
Yeah, and opportunity is always what we like to sign these podcasts off with. Look, thanks, Bruce. I mean, a couple of key takeaways for me is just, again, reinforcing that, it shouldn't be a transactional relationship. It's very much a partnership, and it's really about building a team around yourself, and the bank and the bank manager should be part of that team, a trusted business partner. And I suppose, like any team, if you're not comfortable, you don't feel they're a good fit, it's around finding someone that is, because they can be crucial to the long-term success of your business. So, ensure that you've got that level of trust, you're having that constructive, challenging, and really getting the most out of the relationship to really ensure that future long-term success of your business. So, look, thanks again, Bruce. I really enjoyed chatting with you today.